The price is lying, and the spread is the only thing telling the truth right now. Because overnight, the gap between what the screen says silver is worth and what real metal is actually clearing got wider. And that is never just a quirky premium story. That's the plumbing talking. That's stress traveling through the pipes. And if you understand why that gap widens, you stop getting hypnotized by the headline candle, and you start seeing the next move before it shows up in the chart. Here's the conflict you're watching in real time. Paper markets want silver to behave like a clean, liquid macro ticker. One number, one narrative, one neat correlation to rates or the dollar. Physical markets don't care about neat. Physical cares about timing, form, location, and deliverability. And when the physical side starts charging a bigger now fee, while paper prints wobble or even dips, it's basically the market admitting something uncomfortable. Price discovery is splitting. Not forever, not in some dramatic movie way, but enough that it changes risk, volatility, and the odds of a squeeze-style continuation. And I'm going to give you something concrete by the end of this, levels that matter, what to watch over the next week or two, and the one hidden detail that decides whether this is a temporary flare-up or a structural reset. First, let's clean up the phrase paper versus physical spread, because people throw it around like it's one thing. It's not. Sometimes it means retail premiums on coins and small bars. Sometimes it means the difference between spot and what wholesalers are actually quoting for good delivery bars. Sometimes it shows up as a weirdness between London-style liquidity and US delivery dynamics. Sometimes it's hiding in the futures curve itself, nearby contracts behaving differently than deferred contracts because the market is paying to pull metal forward in time. That last one is the key, because the hidden detail, this is the part most people miss, is that the stress is not primarily in the headline price. It's in deliverability. And deliverability is priced in the front of the curve and in the real-world premiums that only show up when someone needs metal now, in a specific form, in a specific place. The headline price can be managed by liquidity. Deliverability can't. And that's where the real pressure starts. Now, why does the world love to call this nothing? Because it's just retail premiums is emotionally soothing and institutionally convenient. Retail premiums are messy, localized, and easy to dismiss. They let people keep their macro model intact. They let funds keep treating silver like a trade, not a supply chain. They let commentators sound calm, and calm is profitable when you're the one selling liquidity. But the market doesn't widen that gap overnight for no reason. The overnight part matters. That's a tell. When dislocations appear quickly, it's usually because something calendar-driven collided with thin liquidity and forced behavior. Delivery windows, options hedging, month-end positioning, or a geopolitical headline that shifts where metal needs to sit. This week has all the ingredients. A risk-off impulse pushing metals to new highs, policy and tariff noise pushing inventory decisions, and a calendar where liquidity thins at exactly the wrong time. And when liquidity thins, spreads start talking louder than price. Let's talk about the why now trigger without making it feel like a lecture. Markets are not continuous, even when the chart looks continuous. There are moments when participants are forced to act on the calendar. Delivery cycles have deadlines, options have expirations, funds have month-end and quarter-end reporting pressure, and there are also days when U.S. market participation is reduced, holiday sessions, overnight sessions, times when the big real money crowd isn't fully engaged. When the market is thin, small imbalances don't get absorbed smoothly. They gap, they whip, they push stress into the places that can't fake it, like nearby spreads and physical premiums. So if you're wondering how something can change overnight, that's how. It's not magic. It's timing plus constraints. And the next detail is what flips the whole setup. Constraints in silver aren't just about how much silver exists on Earth. They brag about how much is deliverable in the form that settles obligations and meets industrial and investment demand without delay. This is where the inventory conversation becomes more than a talking point. You'll hear people say, there's plenty of silver in warehouses. Okay, but there's a difference between silver that exists and silver that is available for delivery against contracts. There's silver that meets standards but is not currently registered for delivery. There is silver that someone owns and doesn't want to part with unless price rises a lot. There's silver that's in the wrong geography. There's silver in the wrong form. And then there's deliverable supply, the stuff that can actually satisfy the immediate promise embedded in a futures contract or a physical order without a negotiation. That deliverable versus non-deliverable distinction is not semantics. It's the whole game. Because a paper market can create claims infinitely. A physical market can't create bars instantly. Mines don't ramp like software. Refining and fabrication have lead times. Logistics have bottlenecks. And the silver supply chain has an extra twist that makes it nastier. A big chunk of silver production is byproduct. It's not a pure silver mine flips a switch story. If silver is coming out alongside other metals, supply doesn't respond cleanly to price. That means when demand jumps, or when inventory gets pulled into a new place for policy reasons, the market S first response is not more supply appears. The first response is premiums move and spreads move. That's the signal. That's the real signal. Now let's bring the paper side into it, because this is where skeptics get lost. They see futures trading as fake, and physical as real, and they stop there. That's not useful. Futures are not fake. They are the primary arena for risk transfer. They matter. But futures have mechanics, and those mechanics can temporarily distort the headline price while simultaneously amplifying physical tightness. Here's one simple mechanism: term structure. In a normal comfy market, the futures curve tends to be gently upward sloping. Later delivery is a little more expensive because of carrying costs, financing, storage, insurance, convenience yield, all that. That's contango. It's the market saying, take your time. But when the curve inverts, when nearby delivery is priced higher than later delivery, that's backwardation. That's the market saying, pay me now. And when silver starts shouting, pay me now, it means someone is paying for immediacy. Someone is stressing about getting metal sooner. Someone is pulling supply forward. And that's not the part that matters because it's dramatic. It matters because it forces participants to do things they don't want to do. It forces shorts to consider delivery risk. It forces inventory holders to decide whether to lease, sell, or withhold. It forces industrial buyers to lock in supply earlier. It forces arbitrage desks to move metal between hubs. And it forces market makers to widen spreads because their hedges are no longer clean. That's where you get the paper versus physical gap widening even when price looks fine. The gap is the friction cost of urgency. Now stack the next layer, the location problem. There's a London-style liquidity world where paper and unallocated claims can dominate. And there's a US delivery world where specific bars and warehouse mechanics matter more. When policy or tariff risk spikes, location suddenly matters. If someone believes there is a non-trivial chance of tariffs or restrictions affecting trade flows starting February 1st, you don't wait until February 1st to act. You move inventory ahead of the deadline. You pull metal into the jurisdiction where you want it. You preposition. And when a lot of people do that at once, you get a very specific kind of stress. Not silver is gone, but silver is not where it needs to be. That produces dislocations. It produces premiums. It produces spreads that widen overnight. Because moving metal is not instantaneous, and the paper market can only pretend the world is frictionless for so long. Now let's do the part that keeps you sane. Proof stacking. Not one argument, not one chart, a stack, mechanics plus symptoms plus flows plus structure. Because if you rely on one indicator, you will get emotionally farmed by the next downdraft. Proof point 1 is price context itself. Silver has been moving violently and fast. In the first part of this year alone, spot has been printing in the 90s, with recent days pushing into the mid-90s range, and the path there has not been smooth. That kind of acceleration changes behavior. It forces risk managers to tighten, it forces shorts to reevaluate, it forces buyers to chase. And in fast markets, the spread is often the first place stress leaks out, because it's the first place participants pay for immediacy. Proof point 2 is the curve behavior and nearby dynamics. When you see the prompt area behaving differently, nearby contracts acting tight relative to deferred contracts, that's a classic signal that the market is paying for time. Even if you never touch a futures account, that matters to you because it changes the odds of gap risk. Backwardation-like behavior is basically the market telling you there's a convenience yield to holding metal now. And convenience yield is a polite way of saying we're not fully confident supply is effortless at the margin. Proof point 3 is the warehouse category reality. People love to quote total inventories as if it has a single tank you can drain, but the market is not one tank, it's compartments. Deliverable versus non-deliverable, warranted versus merely eligible. Metal that meets standards but is not currently offered into the delivery mechanism. In tight moments, the market doesn't need total inventories to hit zero. It only needs deliverable inventories to feel scarce at the margin. And when deliverable categories feel tight, you see it in spreads and in the cost of sourcing specific bars. That's the part that matters. Proof point 4 is the real-world symptom check. When the paper versus physical gap widens, you start hearing the same phrase in different accents. Available, but not cheap. Dealers might have product, but they won't quote it near spot. Wholesalers might have bars, but lead times extend or premiums jump. Small format products often show it first because fabrication is a bottleneck and retail demand is reflexive. People chase when price moves. But in a true stress event, it doesn't stay retail. It creeps into larger units. It creeps into wholesale quotes. It creeps into the kind of metal that actually arbitrages between hubs. And that's where things get serious. Proof point 5 is institutional behavior and flows. In a metal like silver, you can have strong investment inflows and still see savage paper sell-offs. because the marginal buyer and marginal seller aren't the same participant. Real money can be allocating while leveraged players are de-risking. ETF-type demand can be strong while futures positioning is getting squeezed or forced to cover. That matters because it creates the exact kind of tape that confuses people. Price dips hard, headlines scream bubble popped, and the spread stays tight or gets tighter. That divergence is a tell. It's the market saying, this sell-off is not relieving physical stress the way you think it is. And now the sixth layer, because you asked what changed overnight. And this is often the culprit in that time frame. Options reflexivity. You don't need to be an options nerd to get this. Here's the simple version. When price runs toward big, obvious strike levels, positioning concentrates. If call activity is heavy around certain strikes, dealers who sold those calls often hedge by buying futures as price rises. That hedging isn't an opinion, it's mechanical, it's delta hedging. And if the market moves into a zone where their hedging demand increases faster than price moves, where gamma effects kick in, then the market can start feeding itself, not forever, but long enough to create violent bursts. Here's the important part. That hedging often expresses itself first in the most liquid paper instruments, while physical sourcing lags. That mismatch can widen the paper versus physical gap. And then, when the tape finally whips back, because a hedge fund takes profit or because liquidity returns, the physical side doesn't instantly relax. Premiums and spreads can stay elevated. That why you can get an overnight widening that doesn't immediately mean the price goes straight up tomorrow. It means the market is under tension, and tension changes the probability distribution. Now, let's do a quick pattern interrupt in a tiny calculation, not to show off, but to ground the feeling. A $5 move on a $90 silver price is not a shrug. That's more than 5% in a blink. In a metal that already has a reputation for violent swings, a 5 to 10% weekly range becomes normal fast. And when volatility becomes normal, the psychological game becomes the main game. Because volatility is how the market transfers the metal from impatient hands to disciplined hands. That's how it works. That's how it has always worked. And the next detail is what flips your behavior from reactive to prepared. You need a two-scenario lens, so you are not emotionally hostage to the next candle. Scenario 1 is the controlled pullback and retest. Price takes a breath. It pulls back toward obvious support zones. It shakes out late longs. The spread tightness and physical premiums might cool slightly, but do not collapse. The curve remains stressed at the front. In this scenario, what you watch is whether dips are met with aggressive buying and whether the market holds above key psychological levels. In the current neighborhood, round numbers are not just meme levels, they're risk management levels. Think in zones like the low to mid 90s as the battle area, with $90 as the psychological line in the sand. If price breaks under a level like $90 and the spread also relaxes sharply, that's your first warning that the dislocation was more hype than structural. Scenario 2 is the continuation squeeze and gap risk. That's where the market doesn't give you a clean pullback. Liquidity thins, headlines hit, the curve stays inverted at the front, and the tape starts gapping through levels. In that world, $95 is not resistance, it's a doorway. And $100 becomes the magnet everyone pretends isn't possible until it or us suddenly on the screen. In this scenario, your main risk isn't being wrong. Your main risk is execution, gaps, slippage, and emotional decision-making. Because squeezes don't move in polite stair steps. They move in air pockets. Neither scenario is a promise. Both are a map. And if you have a map, you don't panic when the wind picks up. Now let's address the part everyone tiptoes around. Suppression. Manipulation? They're holding it down. Here's the finance credible way to talk about it without turning your brain off. Markets don't need cartoon villains to create weird pricing. They just need incentives and structure. If large participants have reasons to prefer stability, risk limits, hedging books, liquidity provision mandates, political optics, they will act in ways that dampen or smooth price, especially in paper markets where they can transact size quickly. That doesn't mean there's a secret committee setting a number. It means the structure favors a certain kind of behavior. And when the physical side gets tight, that structure gets strained. Spreads widen, premiums jump, liquidity thins. The market starts to reveal where the real constraints are. And that's why the overnight widening matters. It's the structure getting strained, not just the crowd getting excited. Now, what changed specifically? You're likely looking at a stack of catalysts, not one. First, a macro shock. Safe haven demand has been ripping through metals on geopolitical and policy uncertainty. And recent tariff threats have injected a very specific kind of urgency. Location urgency, inventory urgency, what if trade flows change urgency. Second, a calendar moment. Reduced liquidity sessions and the approach of key deadlines make moves more discontinuous. Third, hedging dynamics. Options and futures positioning can amplify the move on the way up and make the tape look irrational, even while physical tightness persists. Fourth, Supply chain reality. You don't conjure refined, deliverable bars overnight. And when demand spikes, industrial or investment, you pay for immediacy. But here's the thing that matters most going forward. Not why did it widen yesterday? The actionable question is, does it stay wide? Because if the paper versus physical gap snaps back quickly, that's the market saying this was mostly a liquidity event, an overnight air pocket, a retail premium flare, a headline squeeze that didn't translate into persistent deliverability stress. If it stays wide or widens in waves, that's the market saying there's a deeper mismatch between claims and sourcing. And if that's the case, the next week or two becomes less about predicting a straight line and more about watching which side breaks first. The paper price capitulating upward to match physical reality, or the physical premium collapsing because supply truly loosens. So, what do you watch, specifically, so you're not guessing? Watch the spread behavior relative to price. If price sells off and the spread stays stressed, that's bullish tension. It means the sell-off didn't fix the real-world problem. If price rallies and the spread relaxes, that can still be bullish, but it's a different kind, more healthy normalization than pressure cooker. If both price and spread collapse together, that's your invalidation signal for the tightness thesis. Watch the front of curve tone. You don't need to memorize symbols. You just need to pay attention to whether the market is paying a premium for the near term versus later months. If the curve remains inverted or unusually tight at the front, urgency remains. If the curve steepens normally, urgency is fading. Watch warehouse and deliverability chatter in a sober way. Don't get hypnotized by total numbers. Pay attention to deliverable categories and what happens around delivery windows. The market don't have to run out to behave like it is running out. It only needs enough participants to demand delivery or physical sourcing at the same time. That's how squeezes happen. Watch real-world premiums in more than one place. If only one corner of retail is tight, it can be localized. If tightness shows up across multiple channels, coins, bars, wholesale quotes, and regional markets, that's more meaningful. And be careful. In fast rallies, some premiums are simply dealers protecting themselves from repricing risk. That's not bearish or bullish by itself. That's volatility. The signal is persistence and breadth. And watch the dollar and rates, but don't let them hypnotize you. Yes, macro matters. A weaker dollar and easing policy expectations can fuel metals. But silver is not just a macro metal. It's also a supply chain metal. It's industrial. It's investment. It's a hybrid. That hybrid nature is why it can be sleepy for years and then turn feral in weeks. And if this one level breaks, the math changes. The crowd starts treating silver like a monetary asset again, not a quirky commodity. Now let's talk risk, because this is where most people lose trust in content. They hear a bullish narrative, they get excited, they get chopped up, and then they decide it was all hype. The truth is more annoying. Price can whip around violently even if the thesis is correct. In fact, if the thesis is correct, if the market is under tension, volatility usually increases. That's the cost of the regime shift. That's the admission fee. So your job is not to predict every wiggle. Your job is to separate trend signal from noise. Trend signal is the persistence of physical tightness, the tone of the front curve, and the market's behavior around key levels. Noise is the intraday flush, the headline panic, the stop run that happens in thin liquidity, and then reverses before you can blink. And the market will absolutely try to emotionally manipulate you with that noise. It will do it with sudden red candles that make you feel stupid for being early. It will do it with sudden green candles that make you feel desperate for being late. It will do it with confident narratives on both sides that sound like certainty. Your shield is simple. 2 scenarios, 1 invalidation level, and a checklist. Here's a clean way to frame it this week without pretending you have a crystal ball. If silver holds the $90 zone on a pullback and the paper versus physical tension remains elevated, that's constructive. It means dips are being bought and urgency persists. If silver pushes through the mid-90s and starts living above it, then the next magnet becomes the big psychological $100 level, and the risk shifts from will it pull back to how violent will the gaps be. If silver loses $90 decisively and the spread collapses with it, that is your sign the market found supply or liquidity returned in a way that relieves stress. Your thesis weakens, and you stop treating every dip as a gift. Notice what I'm not doing. I'm not promising you a guaranteed outcome. I'm giving you a structure to interpret new information without panic. Now, one more pattern interrupt. Who's forced to act next? If the spread stays wide, the people who get forced are the ones who promised liquidity. Market makers widen their quotes or step back. Shorts who rely on rolling their position cheaply discover rolling is no longer cheap. Industrial buyers who were comfortable hand-to-mouth start pulling forward procurement. And inventory holders, especially those holding deliverable bars, have leverage. They can demand higher prices for immediacy. They can say no. That ability to say no is what turns a normal market into a stressed market. And it's why the physical premium is not a meme, it's bargaining power. On the flip side, if the spread normalizes, it usually means one of three things happened. Supply loosened at the margin, demand cooled, or the financial system provided enough liquidity and hedging capacity to smooth the mismatch. Any one of those can happen quickly, which is why you never marry a thesis. So what comes next, practically over the next 1 to 2 weeks? Expect volatility first. If you're waiting for calm confirmation, you might never get it. The market often confirms the story by being chaotic. That's annoying, but it's honest. Watch for a retest attempt. Even in strong trends, markets like to revisit levels that were previously ceilings. If silver has been accelerating, it may try to come back, tag a zone like $90, $92, and see if buyers defend it. If it does, and the spread stays elevated, that's a powerful trend intact signal. If it slices through and the spread relaxes sharply, that's your warning. Watch for continuation risk on thin liquidity moments. Overnight sessions, headline-driven hours, and any calendar pinch points can produce sudden gaps. If you're a skeptic, this is where you stay skeptical in the right way. You don't dismiss the move, you respect the execution risk. And watch for the market to try to trick you with a narrative pivot. If price dips, you'll hear the bubble burst. If price rips, you'll hear the mania is here. Both stories are designed to make you act emotionally. Your job is to act like a risk manager. What changed in the spread? What changed in the curve? What changed in the symptoms? If nothing changed, it's probably noise. If something changed, adapt. And here is the final revelation I promised. The paper price is not the only price. In stressed metals, the spread is the price. The spread is the cost of immediacy. The spread is the lie detector. If you want to know whether the market is truly loosening or tightening, don't just stare at the headline candle. Stare at what the market is charging for now versus later, and deliverable versus exists somewhere. That's how you stay ahead of the crowd without turning into a conspiracy addict. You don't need certainty. You need structure. You need mechanisms. And you need the humility to say, if this invalidates, I'm out. That's the difference between being early and being reckless. If you're still here, you're already in the minority. The people who watch the plumbing, not the headlines. Stick with that identity. Build a checklist. Compare notes with other adults who care about mechanisms, not hype. And when the market tries to weaponize volatility against you this week, you'll recognize it for what it is, a transfer mechanism. Because if the paper versus physical gap stays wide, the market is telling you something simple and brutal. Someone is paying to get metal now, and that pressure doesn't disappear just because the chart pauses.